Hello, and welcome to the Coldstream's Investment Strategies Group quarterly webcast. Today it is also a year-end review. I am Howard Coleman, Coldstream's Chief Investment Officer, and with me on the call today is my colleague Nina Rose, the Portfolio Manager for Elaine Heller's team. Our format remains as it has in the past. My colleague Nina will address a year-end market recap, and I will then address our special topic. The topic is, will it be huge? Trump policies and their market impact. I want to be clear that we do not intend to address the merits of Trump policies one way or another. Our goal here today is to discuss the economic impact of those policies. Please bear with us because the call was scheduled for 30 minutes, but given the interesting nature of the topics, it may go a bit longer. On your screen, there is a place to ask questions. Please feel free to type in the question and submit it to us. We hope to be able to answer questions, but please understand that if this call goes long, we may not be able to get to your question. It would be best at that point to follow up with your portfolio manager or your relationship manager. And if you want to talk to me personally, they certainly will know how to get in touch with me. We look forward to presenting these topics to you today. That covers our housekeeping. We're ready for the recap. Nina, take it away.
Thanks, Howard. Really appreciate that. What an unexpected year 2016 ended up becoming. One could actually probably couch 2016 as maybe the year of the long shot. Not only just in our political atmosphere was the long shot, did we see long shots winning, but we also saw it in the sporting world. Leicester winning the premiership was actually, they won the championship league, and that's European football. What a credible odds to overcome at 5,000 to 1. Our own Chicago Cubs, after a 100-year drought, managed to win the World Series. And on the political side of both sides of the pond, we had the Brexit vote at 4 to 1, and of course, our topic today, Donald Trump winning the U.S. presidency. Part of the reason why 2016 was a rather unexpected year is if you look at the chart here, we'll see how the beginning of the year ended up taking shape. We started off certainly on a pretty big slide in the beginning of the year. We had some concerns around the oil sector. Corporate earnings were contracting from the previous year. There were some spillover effects from China. So the first couple of months of the year certainly did get our cages a little bit rattled. I'm not really sure that we had a lot of prospects for much more than mid-single digits on returns of the S&P 500. Fortunately, we rebounded in the front half of the year, only to run into the wall of the Brexit sell-off. Brexit lasted only a couple of days and then we were able to climb that huge wall of worry after Brexit. The next test for the markets of 2016 was the U.S. presidential election. And although markets were starting to weaken as November 8th approached, as we all know now, or most of us know now, we ended up climbing a significant wall of worry and ended up posting some incredible numbers for the U.S. domestic markets. Most analysts on the front half of the 2016 year did not anticipate double-digit returns. The election, the fourth quarter, certainly did bring about an enormous amount of change in the S&P 500. It may not be reflected, the entire 3.82% may not fully be, it may feel that it was actually a lot more during the period, but just bear in mind we were starting to sell off moving into the election. As you can see, the United States was certainly the beneficiary of the gains of the year. Where there is a dichotomy, there is a determination or actually a split between the fourth quarter pre-election and post-election. And it's really noticeable if you look at the international bond market and you look at the emerging equity markets. A lot of this response was, a lot of the sell-off in the fourth quarter was really, it had a lot to do with the election itself. Part of the reaction after the election was the US dollar increased significantly, our interest rates increased significantly, and some of the policies that were about ready to come to fruition gave those areas of the global market some reason to pause. If we kind of take a look at our own S&P 500, we've drawn a red line. Think of that as the roof, the price of the roof of prices. If you draw that line all the way back to really the back half of 2014, the market had largely been range bound. We actually were able to break out of that range really right as the Brexit recovery climbed that wall of worry. From a technical perspective, breaking out of a long-term range like that is often a good sign that the market has now got some room in order to move higher. With lofty prices on the market, with the S&P, with the current market and the condition, there were really some winners and some losers in the S&P 500. The obvious winners from this chart were the financial sector. Financials really had a bang-up year for a couple of reasons. One, interest rates were starting to go up, which benefits banks. But two, the new administrative policies indicated that there would be potentially deregulation within the sector, which really gave a wind at the back of that particular sector. On the flip side of it, some of the interest sensitive, some of the high dividend paying stocks didn't exactly fare very well. Utilities, pharmaceuticals, and staples oftentimes have been replaced in the low interest rate environment for people who were actually looking for income. Healthcare, all unto itself, was quite possibly had a combination of the move away from the higher dividend paying stocks and also had some concerns around the potential policy issues that Howard's going to cover with the new Trump administration. In looking at the S&P 500, we do look at price to earnings multiples, and oftentimes, and currently right now, we're looking at things at just north of 21 times earnings. The dotted line that's moving across the middle of that looks at long-term averages. Something to keep in mind though, even though we are above those dotted lines, markets can remain above averages for long periods of time. So one thing we certainly do want to look at is the 21 times earnings we do think are pretty well fair valued, considering we've had some changes in the earnings landscape. Prior to going into 2016, we had been in what would have been deemed through 2015 as an earnings recession. A lot of the earnings that were in the S&P 500 were being affected by the beginning of the year rout in the oil sector. Energy, which makes up a substantial portion of the earnings in the total earnings of the S&P 500, was actually detracting from the overall earnings of the S&P 500. As you can see here, we started to recover in the third quarter of 2016. And if you remember, or if you think back, oil went from mid $20 a barrel in the front half of the year to north of $50 a barrel now. Now you have energy companies that are actually adding positive earnings to the S&P 500. And potentially, this could be the turning point for corporate America to expand their earnings multiple. So right now, 21 times earnings actually does look fairly valued. In looking at the small cap sector, Russell 2000, we've drawn a big line across the roof, as I called it, the roof of the prices, and it actually goes all the way back through to 2014. The Russell 2000 had a breakout after the Trump administration, as you can see, the parabolic move on the far right-hand side of your screen. Now, there's a couple of things that are unique to small and mid-cap sector. One, this particular group ends up being a little north of 20% of financials. Think of small banks, small and regional banks. These make up a large portion of this particular asset class here. Within that small bank, there's been a lot of M&A activity. The Fed is actually encouraging consolidation. And as I mentioned before, both rising interest rates and deregulation bode very well for this particular, for the small cap financials. The other issue here in this small and the mid-cap sector has possibly a lot to do with Trump policy. Policy meaning a large majority of these small and mid-cap folks get their earnings from inside our borders. And so there won't be any issues with trade policies that are affecting these that much. One other benefit, which actually, as we're looking at the earnings valuation here on this, one benefit why earnings actually are looking at, again, a little north of 21 times earnings. One of the issues that may support this type of earnings multiple is the possibility of merger and acquisition. Howard will be talking briefly a little bit about some of the repatriation of U.S. dollars, but if you're a small and a mid-cap company and large corporations are bringing dollars back, it's fair to think that there will be some continued consolidation in this sector, which would support the valuations here. The developed world wasn't exactly as lucky as we were here in the United States. They too went through the Brexit issue and recovered after Brexit, but the actual election what really turned out to be pretty flat for the developed world here. One thing that we do like about the developed world is that the valuations in the developed world are a bit more attractive. Does that really mean that we want to put money in the developed world? Well, there's some good things that are actually going on inside the developed international developed markets. And when we're talking about international developed, we're talking about the Eurozone, Japan, Australia, and Asia. In these areas, monetary policy is quite accommodative, and they continue to stimulate their economies through monetary policy. Inflation is starting to pick up, which is good, and unemployment in the developed countries is actually starting to decline. One thing that we are quite mindful of in the developed world are the large tail risks that potentially lie out there. France and Germany are also going to be going through their elections, and Britain, as you may know, is going to be triggering Article 50 this year in order to start the EU negotiations of how to break apart from the EU. One bright spot of the global community has been the emerging markets. Emerging markets may have benefited from a couple of things. One being there were some regime changes that were significant for this marketplace. Both Brazil and Argentina went through a regime change. And in India, anti-corruption crackdown led to monetary reform, which was beneficial for the emerging markets. Unfortunately, the fourth quarter, certainly emerging markets took it on the chin in the fourth quarter. And that could possibly have to do with a number of things. Fourth quarter, as we mentioned before, interest rates spiked up. The dollar became a lot stronger. And again, the Trump trade policy certainly could have impacted emerging markets. We look at emerging markets from a valuation perspective. It looks attractive at 14 times earnings. However, it's been 14 times earnings and below earnings for several years now. So are we in a value trap? Are we being trapped in emerging markets, or is there a reason to be constructive on emerging markets? Emerging markets have often been tied to the commodities market, and commodities are starting to stabilize. If you think most developed economies potentially will start looking towards fiscal policy where they're stimulating their economies by building out infrastructure, this could actually be a boon for emerging markets, as copper, iron ore, and cement are all resources for emerging markets. Now, one of the big losers after the post-election was interest rates. And there's a couple of ways that you can look at this, but one thing that we are certainly looking at is the enormous move from election day to the current yield on the 10-year note at 2.4%. This type of a move has us wondering whether or not this is an inflection point in interest rates. And are interest rates now done with the 30-year bull market? Meaning, are we done with interest rates continuing to fall? And is this the type of year that we are going to start seeing interest rates stop declining and start rising? As you can see, historically speaking, interest rates have been coming down for the better part of almost 30 years. Now, just because we may be at an inflection point of interest rates actually turning and starting to make the climb back up to more normalized interest rates, it doesn't mean that that's going to happen overnight. Oftentimes, this type of an interest rate trend can last a decade. It can last long periods of time at lower for longer. But one thing that we are pretty mindful of is the Fed has signaled that they want to continue to start raising interest rates, and all signs point to a slow, gradual rise from the bottom of where we were. Now, typically, we don't see interest rates move with the magnitude of what we saw in 2016. But one area that was significantly impacted was the municipal market. What you're looking at here is oftentimes the municipal market actually, because it's tax-free, trades below the Treasury market. In this case, you can see on the left-hand side that a more normalized curve where the white line is trading in tandem with the red line. But if you look at the 10-year on municipals, it went from 2% to 3% within the first couple of 3 weeks after the election. Municipals were certainly hit very, very hard at this period of time. There was concerns about tax policy potentially impacting municipals, or certain policy changes that might come to tax rates impacting municipals. But since then, most municipals have actually come back in. Their spreads have actually come back in. Municipals historically, through all types of economic environment, has actually been attractive. For most people, they've been an attractive diversifier, and we continue to think that municipals are an important part in people's overall portfolio. Structurally, going into 2017, there's a reason to actually like municipals, because the supply of municipals may actually be less going forward than it has before. Now, not all bonds are tied to interest rates, and high yield isn't tied to interest rates necessarily. It's more closely related to corporate activity. If you recall, when I started out, we were in the doldrums of an energy sector that had some potential for heavy defaults. So the spreads started to widen. And as the economy began to turn around, corporate earnings in the third quarter bottoming and starting to show life again, the spreads on high yield corporate bonds started to contract. And as you can see, the return on the high yield market was significant at 17.3 times, nearly 17.5%. Again, in looking at not just high yield, corporates are very tied again to the economy, and corporate spreads continue to contract. So there is a good feeling in the yield producing sectors that economically we continue to maintain our footing. We get a lot of questions about this being actually the most unloved recovery since the recession that we've ever seen. Part of it, as you're looking at the bottom blue line, is actually the recovery since 2008. It's been very shallow, and a lot of folks that we talk to in meetings are asking that maybe the time is starting to run out for this growth. Maybe it's just time for things to start changing. Well, because the recovery has been so shallow, it is quite possible that the time of this recovery may be actually longer than previous recoveries. As you can see, red and blue lines actually have been longer than 40 quarters. So it's entirely possible that the nature of this type of recovery, because it's shallow, it'll actually go on for a much longer period of time. One thing we always keep in mind in our toolbox in order to understand whether or not it's time for a recession or not is that we look at leading indicators. Leading indicators have historically been a very good key in trying to understand when we may need to change our allocation strategy. We're looking for sustained and consistent reversal in our leading indicator composites. And as you can see from the chart, things are very strong. They're either strong, improving, or in fair conditions. So should these indicators sustained and consistently roll over, we might be looking for a recession anywhere from 1.5 years to 2 years out. But that certainly isn't in our base case right now. All indications are that we will continue at least at the pace of growth that we've been seeing. I'm going to turn it over to my colleague Howard in order to talk about the policy and how the next year's economy will be affected.
Thank you, Nina. I'm going to address the topic of, will it be huge? Trump policies and their market impact. First important thing to note is that the basis of Trump's policies are pro-growth. Lower corporate personal tax rates are stimulative. Repatriation of corporate profits, that is bringing corporate profits that sit overseas back to the U.S., is stimulative. Infrastructure spending is stimulative. All of those are pro-growth policies, and if they are enacted, they will enhance growth in the U.S. There's risk to these policies, however, and the first and probably the most major one is a trade war, and a trade war would have a significant impact on growth, and we'll talk about that. The second is really not within Trump's control, but it's Fed policy, and Fed policy could be working at cross purposes with a stimulative policy of Trump as the Fed is entering into a raising cycle. How they handle that in cycle will be important to determine whether growth continues or not. And then other risks are other tax reform measures, and I really need to put that under both risks and pro-growth elements because there's two tax reform measures that I want to mention. Of course, it's all speculative as to whether they will ultimately be implemented or not, but they are worth mentioning, and I will discuss those in a moment. First, let's talk about corporate tax rates. There's no denying that the U.S. has the highest marginal corporate tax rate in the world, and by a lot. Our high tax rate, 40% is rounded, it's 39.6% actually, but it's still the highest in the world. There's a clear desire among both Congress and Trump to reduce that corporate tax rate. The current proposals are that it gets reduced to 25%. That would certainly allow considerably more corporate cash, corporate profits, which would clearly be stimulative. There are some questions, and serious questions, about the timing of that, and what can be done by a process called reconciliation and what cannot. And reconciliation is a process that is budget related, that only requires 51% approval by the Senate, and of course, if it is tax reform, that will require 60% approval, and of course the Republicans don't have a 60-seat majority, which could impact its ability to pass. So these are clearly stimulative, the reductions of corporate tax rates, the timing of it, and the scope of it is currently uncertain, but if enacted, it would be a pro-growth policy. The second issue is repatriation, and repatriation is cash held overseas. This chart shows the blue line is those sectors in the S&P that hold cash offshore. And you can see the technology companies hold an enormous amount of cash offshore. That's the blue line. They hold far more cash offshore than onshore. There is a startling $2.4 trillion of unremitted earnings overseas. In 2005, we had a tax repatriation holiday where companies could bring cash back tax-free. There were $600 billion of overseas cash at that time, and 60% was brought back to the U.S. Out of the $2.4 trillion, if there is either a lower tax rate or a tax holiday, and let's say $1.1 trillion is brought back, that's 5.4% of current GDP. That has an enormous impact on the economy. And this is the tax reform measure that I want to mention that has some pro-growth component, which is that companies would be able to expense CapEx. Right now they have to amortize it over time, and that's an encouragement to spend on capital expenditures. If that goes through along with the corporate holiday, we may actually see some capital expenditure as opposed to what has happened very often when corporations get cash, which is they are used for buybacks, merger arb, or dividends. All of those are positive to the stock market, but may not have the same economic implications, favorable economic implications that CapEx spending does. By the way, the House's proposal right now is to tax these at 8.75% on cash and 3.5% on non-cash assets. The other issue that President Trump is proposing, and this should have been listed on my first page, but I inadvertently omitted it, is pages of regulation, it's reduction of regulation. And we can see the increase over time in the pages of regulation in the Federal Register, and the Obama administration increased that dramatically. We're not offering an opinion as to whether regulation is good or bad and in what context, but it does certainly impede profitability in certain cases because it requires staff and overhead expenditures to deal with. It also limits, of course, the activities of banks. The reduction of regulation would potentially lead to more stimulative growth in the economy as well. Merger and acquisitions, and we mentioned the wind. This is a chart of merger and acquisitions per quarter over the last numerous years, and we can see last year was a boom for merger and acquisitions, and that was even in the face of several large mergers being blocked by the Department of Justice. With corporate cash coming back, we would expect a great increase in merger and acquisitions. But here is where the risk that I mentioned on the first page in terms of corporate cash reform comes in, because there is significant proposals right now in the House to eliminate the ability of corporations to deduct, and individuals, to deduct interest expense. If interest expense deductibility is limited, that will put a crimp in M&A activity, because M&A activity is often highly levered and requires significant borrowing to accomplish, regardless of your cash on hand. So the question is whether the cash coming into the country will outweigh interest deductibility in terms of the M&A activity, and that is yet to be determined. What's the effect of Trump policy? It really has had a very positive effect on consumer confidence, economic confidence. And this is a Gallup poll that measures economic confidence, and you can see since the election, the Trump effect in terms of confidence has been significant. And confidence is a great precursor to expanding economic activity. Of course, in the Volatility Index, this is the volatility of the U.S. stock market, and volatility increases as nervousness increases. Things are pretty sanguine, pretty optimistic right now. The volatility is at extremely low levels. Whether it can remain at these levels for a long period of time is a question, but the market is certainly calm. And short interest. Shorting stock, for those of you who are not familiar with the concept, is a method by which you can bet on stocks going down. So the higher the short interest, the more bearish the market is. And we can see that since the election, short interest in the market has dramatically decreased. Again, favorable sentiment in the markets. Now, of course, when short interest decreases so much, that also poses a risk to future growth, because a lot of times markets run when people have to cover their shorts, and there's long shorts outstanding and people have to cover them. That just drives up the price of the stock because they have to sell their stock. They have to buy back their stock, they have to buy back their stock, and that increases the price of the stock. But nonetheless, a low short interest clearly demonstrates confidence in the markets right now. On the other hand, there's net shorts on U.S. Treasuries. And please recall that price on Treasuries moves in the opposite direction in yield. So a short on Treasuries, a short on prices, is a bet that interest rates and yields would go up. The market is very much expecting a pro-growth policy by Trump causing interest rates to rise. And this is reflected in valuations currently. At the end of the year, and Nina touched on this, this is the end of the year of 12/31. And the blue bar is the past 10 years of valuations. It covers the entire 10 years high and low. The black bar covers the average of that 10-year period, and the black dot is where we are now. The interesting thing about this chart is if you look at the black dot, there is nothing that is below its 10-year average. Telecom services is slightly below, but with that exception, nothing else is below, showing that the market is fairly valued. But as Nina said, valuations can remain high for a long time. And also, as Nina said, the leading economic indicators continue their upward trend, which is bullish for the economy. So all in all, the stimulative nature of things is keeping the market, excuse me, keeping the market bullish. Excuse me, I have a frog in my throat. The currency moves also have been dramatically impacted. The currency moves have also been dramatically impacted since the election. Last year, we saw significant dollar weakening, except, of course, against the British pound. The British pound strengthened significantly after Brexit. Weakened significantly after Brexit. The dollar strengthened against the British pound. Against all other currencies, it weakened. After the election, after pro-growth Trump policies, the dollar strengthened immediately. And if this would have looked significantly different, even more dollar strengthening before last week, because last week Trump made a comment that he actually didn't like a strong dollar so much, and that caused the dollar to sell off. But we have seen significant dollar strengthening. This, of course, hurts exports because it makes goods cheaper. It makes goods more expensive for foreign countries to buy. As I mentioned before, Treasury shorts are at a significant high right now, and we have seen a bit of an uptick in inflation. It has not yet met the Fed's target, but it is approaching it, and Trump's policies should be pro-inflationary. There has also been a long-run economic growth uptick, as GDP has continually declined since 2010, but we have recently seen an uptick in that GDP, and when we look on top of that at stimulative policies, we may essentially continue to see that uptick. U.S. manufacturing is also on the rise. New orders are up 7.2%. Inventories are up 2% and have been up for 18 months in a row. Have contracted by 2%, and contracting inventories are, of course, favorable for pricing. Prices are up 11% and have been up 10 months in a row, and new export orders have been up 10 months in a row as well. So the U.S. manufacturing sector is looking pretty good as well. And of course, Trump is doing everything he can to encourage that sector. All of this has led to an increase in rate hike probability that the futures market is betting on. The blue line is the amount that the market thinks is going to happen at one hike. The orange line is 2 hikes, and the gray line is 3 hikes. The bar is a combination of all 3. We can see that the market is predicting in June that there will be at least 1 hike because the bar is at 70%. But the market is predicting a little over 2 hikes by the end of the year. If this stays in effect, it's probably not enough of a hike to curtail growth. But if we do see a spike in inflation, that could work. We may see some additional hikes, and that could work at cross purposes. The other issue beyond hikes that people were not talking about, but could have an impact, is if you recall, the Fed was engaged in quantitative easing, and quantitative easing meant buying treasuries and buying mortgage-backed securities. They stopped that, but as the treasuries matured and as the mortgage-backed securities matured, they have been buying new ones to replace the ones they own. They have been talking about stopping that program, and if they do, there will be a flood of treasuries and a flood of mortgage-backed securities on the market. And the question is, who will buy them and how that will affect interest rates. Now talking about trade, which is of course one of the risks. It is absolutely true that the U.S. runs a budget deficit, without question, a $500 billion budget deficit. The budget deficit was much steeper before the Great Recession and has been steady for the last several years. Now, in some ways that helps the economy and keeps a lid on inflation. But as you can see, the U.S. worker makes about $20 an hour. The Mexican worker and the Chinese worker make below $5 an hour. That's why Walmart prices have been able to stay so low, and that's why in many ways inflation has been in check, because they say, as they say, Mexico and China export deflation because their prices and their wages are so low, which enables the cost of goods to be low. So as if Trump is successful in bringing jobs back to the U.S., this will also put additional pressure on wages. Now, there has been a historical interconnection between the United States and China. And this really was more prevalent before the recession, but it still exists now, and it has been, there's been disadvantages to it clearly because manufacturing jobs have a lot left, but there have been advantages to it. You can see China is the global manufacturer, shipping low-price goods to the U.S. The U.S. consumer is the primary mover of global demand. It ships its dollar to China. China takes those dollars, buys U.S. debt, treasuries, and mortgage-backed securities, which keeps interest rates low, subsidizes the U.S. consumer, and enables them to buy more goods from China. This has been the cycle we are being in. This is the cycle that Trump is trying to break. And it will be very interesting to see if he's successful to breaking it and how that will play out. Now, although we run a significant trade deficit with China, we also export to China, and we export to China not quite at 1% of GDP, but a significant extent of GDP. And if we got into a trade war with China and that was reduced significantly, that would be negative to U.S. growth. President Trump has also often accused China of being a currency manipulator. And in one sense that is true, and in one sense that is not true. It is clearly true that China pegs its currency, and that is currency manipulation. However, they have not been trying to devalue their currency lately. In fact, they've been doing the opposite. They've been trying to maintain their currency at certain levels. We know that when they've let the currency free float over the last couple of years, it has fallen dramatically. Free float within a band. They have never let it totally free float. So, but this chart shows that the manufacturing sector is a smaller part of GDP growth in the services sector, and that is what China's trying to move to. They're trying to move to a consumer demand-driven economy. And although a lower renminbi helps manufacturing, it hurts consumer demand because it costs more for imported goods. Moving to Mexico, the peso, the poor peso. We have seen up until the election, and the green line is the peso, and the black line is oil prices. And historically, the peso has been highly correlated to oil prices. Not so much after the election. We can see the black line departing from the green line right at the time of the election. And what is happening now is the peso is being devalued, even though oil prices are rising or stable, because of fears of a trade war with the U.S. And although we run a trade deficit with Mexico, we do have significant exports to Mexico. And we can see that since NAFTA, both our imports and our exports have increased dramatically. So the trade balance is negative, but the economy does have significant exports to that country. And here we can see the percent of Mexican exports to U.S. GDP, and that is about 1.25%. And putting that into question in a trade war, would have a significant implications to growth as well. Now, the President Trump's concern about manufacturing and the demise of manufacturing in the U.S., there's no question that has happened. In 1997, it was about almost 17% of GDP. It is now down to close to 12% of GDP. It has fallen in those periods of time. I think if you went back to the 70s, however, you would even see it as a higher percent. But what is interesting is that is not just a U.S. phenomenon. Japan, Germany, and the world have seen a decline in U.S. manufacturing, and that is not only because U.S. manufacturers have lost some jobs to abroad, but it is because that manufacturing has become far more efficient. Far fewer workers are needed to produce the same quantity of goods. And this is demonstrated by U.S. steel production. We don't nearly have the same. We had 600,000 jobs in the 6 million jobs in the steel industry in '71. Not nearly that anymore. I grew up in Pittsburgh, and I saw in the late '80s in that decline there. That's when the U.S. steel mills closed, and they did not go to Mexico. They closed because of efficiencies. But we have seen a steady, recently, a steady amount of steel production, even though the percent of manufacturing in the U.S. has continued to decline. And as we can see here, trade accounts for only 13.4% of the manufacturing job loss. Productivity accounts for about 87% of it. In closing, I think one of the things that we've seen, and Nina talked about, is that the growth of the Trump administration's policies, as well as the tail risk, have caused individual stocks to move in a very different manner. And that has been, and that's called correlation. And we can see that the yellow line is what's called 3-month realized correlation, how much stocks move together. And it's at significant lows. Stocks are moving independently of each other. The market's not moving up all at once or down all at once. What does that mean for investment strategy? Well, over the last several years, it's been very, very difficult for active management to outperform ETFs and passive management. And that occurs when there's high correlations, because it doesn't matter how you select stocks, things move in tandem. As we see dispersion, we believe that active management will benefit portfolios once again. So thank you very much for your call. And we have run significantly over in time. I am very sorry because it's 45 minutes, so please contact your relationship manager or portfolio manager with your questions. And thank you very much.